Welcome to Dental Business RX. Practice success in 30 minutes or less.
Thank you for calling ABC Dental.
Funny thing about profitability. It's one of the prime objectives chased by just about every business owner, while at the same time being one of the least understood subjects, especially for a small business owner running an owner-operated business, such as a dental practice. Case in point, if I were to ask you what your average monthly profit margin is, would you know what it was? Or would you have to go grab a profit and loss statement? And would this profit and loss statement account for the money that you're paying yourself, the compensation you're giving yourself as the owner doctor? And is that compensation at a standard market rate? I mean, ultimately, the real question is, how profitable are you? And it's things like this and a number of other questions that inspired this week's episode. This week's episode, we are going to demystify the subject of profitability. And I'm going to be covering four things. The first is how often, in my opinion, profitability in a dental practice is miscalculated. Two, we're going to get into how to determine a real accurate number that you can rely upon for profitability purposes. Three, we're going to show you how to determine if your profitability needs work. And four, we're going to talk about a little bit at least what to do about it if it needs work. My name is Jeff Bloomberg and I'm your host. And I think the best place to start with all of this is with a real good basic definition of profit. Before I give that to you, I'm going to give you a little disclaimer. I am not an accountant. I'm not a CPA. I am not a tax attorney. So nothing I'm saying here constitutes accounting, tax, or legal advice. And I recommend that you have good folks like that you can rely upon if you have questions that come up. And, as with everything, anything we say, on the podcast or anything you encounter in life, I'm a firm believer that people are responsible for their own condition. Do your due diligence to see if it works for you in your business. All right, so let's get into this definition of profit. What's the basic definition? It's the amount of money left in a business when revenue exceeds expenditures. The amount of money left in a business when revenue exceeds expenditures. If I make $1 million and I spend $750,000, I have $250,000 of profit. You could apply this to an individual product or service. You could look at let's say you charge $1,300 for a crown. If you really wanted to drill down on this, you could look at, okay, what's my labor cost per hour for myself and my dental assistant? How much are materials? How much is the lab fee? And how much are my fixed expenses for that 1 hour of chair time? You could do this. Okay, it comes to, I make $814 on a crown. So that's the profit margin. In other words, after all expenses have been calculated. You could do this for an individual service, or you could do this for your business. That also tells you that there's two components to the profit formula. It's income and expenses. So if you're making $1 million and you spent $750 and you want to make more profit, well, you'd have to make $1.1 million and spend $750. Or $750,000 rather, right? Or make $1 million and spend $650 or $700. It's income versus expenses. Now, where this becomes confusing for a dentist, especially an owner-operated dentist in a private practice. Okay, this is where I think this stuff gets miscalculated a little bit. Let's look at how overhead is normally calculated or expenses. You'll talk to somebody and they'll say, well, a dental practice should have a 50 or a 55% overhead. Okay, so if you're making $100,000 a month, your overhead should be 50 or 55,000. Which would mean that your quote-unquote profit would be anywhere from $45,000 to $50,000. If your overhead's 55%, let's use one number, then your profit should be 45%. But what that doesn't account for in many cases is what the owner doctor should be making. Because you actually have, with relation to this, two different jobs. You actually have three basic jobs. You have the owner job, you have the doctor job, you also have the salesperson job, but I'm not going to jump into that in this episode. But let's just stick with owner and doctor. Each job has a different job description, and each job has a different method of compensation. The owner compensation is profit. The owner provides planning and vision and establishes the business and policies and things of that nature. And what's the owner's pay? Profit. So if there isn't any profit, the owner doesn't make any money. What's the doctor job? The doctor is supposed to treat patients, make patients well, do procedures, complete procedures in a professional manner. How is a doctor normally compensated? Well, in a lot of cases, they're compensated based off of their production. True? So The way a doctor's paid and an owner is paid is completely separate. But if I'm looking at you as the owner/doctor and I go, okay, your expenses were 55%, well, your profit was 45, but that didn't account for you getting paid as the doctor. Do you see? And this is where this whole profit discussion starts to get a little bit weird when you're dealing with a small business, especially where the owner is the primary producer for that business. Let's take it out of dentistry for a second. Sometimes that helps. You can look at this purely from a business owner perspective. Let's say, I don't know, I own a big furniture store. Okay, big furniture store, but I also serve as the CEO of the furniture store. So I'm the owner and the CEO. So let's say we did $5 million in sales in a year, and our expenses, which includes my salary as CEO of $400,000, are $3.8 million. So we grossed $5 million, and our expenses, which includes the furniture and the labor and the salespeople and everybody else, and my salary as the CEO, because I'm there every day being the CEO, is $3.8 million. We'd have how much left? $5 million minus $3.8 million. We'd have $1.2 million in profit. Now, and this is where I want you to start thinking a little bit more like a business owner, not just, the doctor who's working in an office that you happen to own. If I wanted to step back and replace myself as the CEO, what would I have to do? I'd have to find somebody who could actually do the job at the same level I was doing it, and I probably would have to pay them something similar to what I was making. Let's say I'm paying myself market rate as CEO of a furniture store doing $5 million a year. So I would find another CEO and I'm going to pay this person what I was making, which is $400,000. Okay. Then I'm no longer the CEO. I've stepped back. I'm now the owner. So what am I getting paid? I'm getting paid my profit of $1.2 million. Okay. And I'm doing my functions as the owner, right? And my profit is my pay. So yes, I happen to own the business. Prior to this, I was serving as the senior executive, so I was getting compensated as that executive, but I'm no longer the executive. I've replaced myself, so all I get to earn is profit. So now if the business starts not getting unprofitable, I might have to step back in, replace the CEO or take over as CEO again, etc. But ultimately, my pay as the owner is profit. So let's move this over to a dental practice again. I want you to think like a business owner because this is where I think it gets all glommed up. That example I gave you earlier, if you go, well, my overhead's 55%, but that doesn't include paying you, there's no way you're paying yourself within that 55%, as the owner doctor. Your pay is coming out on top of that. Do you see? So your overhead is actually higher than 55%. But how does it usually work? So you have this owner doctor doing $100,000 a month. And there's their salary, labs, expenses, etc. The salaries for the staff come to 55%. So the overhead's 55%, $55,000 a month. So there's $45,000 left over. The owner doctor has a salary that they're taking. Let's say it's $12,000 a month. Okay. And then, so you take 12,000, we're already spending 55, add the 12,000, we're now at 67. So what's left over at the end of the month is $33,000. That sits in an account. That's the quote unquote profit. The doctor doesn't know whether they should take some of that or all of that or whatever. They're going to have to pay taxes on it, which is fine. You should pay your taxes. But there it is. That's their profitability. But the question is, what are they getting paid that $12,000 for? Because there's no way they would find an associate that would do, let's say 75,000 of that 100,000 is doctor production. They're not going to find an associate they can pay $12,000 a month to produce $75,000. There's no way. So let's take a step back. Let's rewind this for a second. If that doctor owner were to replace themselves as the doctor, not the owner, okay, because remember the owner's pay is profit. Okay. But if that doctor owner were to replace themselves as the doctor with an associate doctor, they'd probably have to pay that associate about 30%. Let's just say 30% for now, because that's the math I did before I started the podcast. But let's just say 30%. So my base expenses as the owner doctor, I'm collecting $100,000. My expenses, salaries, lab, etc., are $55,000. But the doctor production is $75,000 of that $100,000. So I have to pay an associate to do that production. So 30%, and I'm sorry about the math, folks. I know that's tough in a podcast, but I'll reiterate it just so you can track with it because this is a good point. I just want you to make sure you get this. So $55,000 in expenses. The associate or doctor produces $75,000 of that $100,000. If I were to pay an associate 30% of that, that's $22,500. So you add that 22,500 to that 55,000 in expenses that already exist. My overhead is actually 77,500. 55,000 in expenses, 22,500 for the doctor pay of 30%. So my overhead is actually 77,500. Because remember, profit is the amount left over after expenses. Well, I got to pay the doctor, right? Because I've replaced myself as the doctor. So if my expenses, after all that, is 77,500, what do I have left over? I have 22,500 left over, or 22.5%. So my overhead is actually 77.5%, and my profit is 22.5. So as the owner, I'm not required to actually be in their chair side. And truthfully, as the owner, that should not involve you being in the practice. If that's just the owner job, the doctor job involves you being in the practice. But the owner job is not something where I have to be there at 9 a.m. till 5 p.m. I'm, doing different things. I'm providing policy. I'm doing this. I'm doing that. It's a different job description, right? Which I can get into more in future episodes if you'd like. As a matter of fact, a few weeks ago, we did an owner checklist, right? But that was predicated on the idea that it was owner doctor. So if you want to calculate this correctly, you want to also account for the doctor expense. You don't want to glom together the owner job description with the doctor job description when you're thinking with profitability. So what should that profit margin be if you were compensating yourself as a doctor at market rate? Because that example I gave you earlier with this doctor is paying himself 12 grand while they do 100, that's not market rate. Well, the margin should be, like in that example I gave you, the margin was 22.5%. Well, the lowest it should be, because this would be applicable. Let's say you opened a practice and you put a bunch of associates in there and you weren't there. You were just maintaining clinical quality, making sure that the practice, you looked in on it, made sure that the work was good, etc., but you were not chairside. And it was just associates, which we're seeing more and more of our clients do. Well, the margin should be at the lowest end, 20%, but ideally it should be closer to 30. So what that means is out the door, all expenses should be no more than 80%. That would be the worst case scenario. And best case scenario, the way it should be, is closer to 70%. If you have a practice with a bunch of, it's an associate driven practice, and that practice is doing 200 a month, the margin should be at least 20%, which would be 40,000 a month. Ideally, it should be closer to 60,000 a month. Okay. If it's 25%, 50,000 a month, that's not half bad. And this is something you can do for your practice if you really want to calculate profit, because the viewpoint that a lot of doctors take when they buy a practice is sort of like, I'm an owner worker. We'll take the owner viewpoint for a second and imagine, what would I have to pay a doctor to do what I am doing? Let's just start with a basic operating number of 30%. Do this for your office. Look at what your production is. You could also, if you have associates, you can include them in this. And you go, okay, if I were to pay everybody 30% of their production, and we collect X amount of dollars, how much do we have left over? That's your profit. Now, if it's less than 20%, let's say you do this for yourself, then you have some work to do. Or, I would suggest that if it's lower than 25%, you have some work to do, and you should be shooting for that 30% number, including if you were to compensate yourself or another doctor that you put in there in your place, assuming that productivity stayed at the same level. So do these numbers for yourself and see where you stand, right? Now, if you want to tighten up profitability, obviously I could spend hours talking about different ways to tighten up profitability, but let's focus on a couple of the bigger points. The first thing I would do is monitor my expenses, okay? Now, the biggest problem with expenses is, how much should I be spending on X? How much should I be spending on marketing? How much should I be spending on my rent, etc.? What's good? What's bad? Well, to help you with that, we have the MGE overhead sheet. Now, I have a version. We had a version that we've given out before. I have a new version. It's much more involved, and it accounts for a lot of things, pretty much any expense you could possibly conceive of. I have the overhead sheet, and I also have it's overhead percentage by expense category. If you want to compare this to your practice, I'll put a download for it on the episode webpage if you want to take a look. I definitely recommend that you do this. But then the other thing you can monitor if you want to lower expenses is efficiency. If I have a hygienist and they have a lot of openings, I'm still paying that hygienist to be there. So these are things we don't think with. A hygienist, they're there. They could produce $800 a day, or they could produce $2,000 if they're fully booked. So if I'm maximizing efficiency, just like if I have a scheduler and they're doing a poor job and I have a ton of openings, I'm still paying them probably about the same amount I'm going to pay a scheduler who will keep the schedule full. So efficiency and productivity are another key thing, because then you're actually getting your money's worth for what you're actually spending. That will help you to lower expense and eliminate waste. The next aspect of increasing profitability is increasing income, right? Now, how do you increase income in a dental practice? There's three basic ways. One is you increase your case acceptance. Generally speaking, if, let's say, you're not very good at presenting a case and your close rate is, 20 or 30%. So you present very often, let's say you present 6 crowns and the patient only agrees to do 2 because that's what insurance covers. If I were to teach you how to effectively communicate with a patient to the point where they really wanted their treatment, chances are you could spend the same amount of time that you spent talking to that patient about those 6 crowns and only getting 2 accepted to get all 6 accepted. So you spend that 30 minutes, and instead of walking away with a $2,400 case, you're walking away with a $7,200 case. That has a huge impact on your overall revenues and productivity. Now, I'll just throw that out there. I've talked about the MGE communication and sales seminars before, where we act for the professional, where we actually teach you to improve your sales skills. I'll put a link to that on the episode webpage. We also have sales training for doctors on our online platform, DDS Success. I'll put a link to that as well. And if you don't know if you are underproducing, here's what I'd suggest. You can fill out our production calculator and talk to one of our practice management experts, and they can tell you, what you could do to maximize your productivity. I'll put a link to that as well. A lot of links this week. So that's the first aspect of increasing revenue, which is sales. There's 2 other aspects. One is fees, and the other is participation in managed care plans. And I could go off on this for a while, but I'm going to keep this real simple. Chances are you're charging too little. You really have to take a hard look at your fees. And this is why the reason why fees end up being low is take a look at when you bought your practice. You may not have changed the fees at all, or maybe you started from scratch. You may have set the fees where they should have been when you started, but you most likely haven't kept up with where fees have gone in the years that you've been in practice. I've seen this happen with I can't know how many times I could say this, but we have a client who comes in, they've been in practice for 12 years, and their fee structure is in the 30th or 40th percentile, meaning that 70% to 60 to 70% of the other doctors in their zip code charge more. All right. So your fees are most likely too low. All right. So you should really examine your fees and make sure that they are really tracking with what they should be. Which brings us to the next point, which is managed care participation. Well, in that case, you're charging too little and there's really nothing you can do about it. The only thing you can do about it is get out of plans. And again, I've been saying this for a while. It's gone from it would be nice to get out of plans to you really just need to at this point and be able to do it in an intelligent way. We can help you. Inflation has been close to 20% from March of 2020 to March of 2023. So the longer you wait, the more of a problem this becomes. And then eventually you find yourself to where, you're priced so low that making a profit is next to impossible. All right. So we've covered the first 2 things, which is, reduce my expenses and increase my revenue. What's the third thing that can affect profitability? It has to do with how your practice is structured. And I'm mainly talking to general practitioners here, GPs. And I could get into a lot of things about this, but I'm going to focus on 2 big ones that I see a lot. First thing has to do with clear aligner cases. Now, I'm not saying not to do these. They're great. You should offer them. But I've seen some offices that just really focus. That's their main source of just, production and revenue. They just really push for clear aligners. They advertise for clear. This is just what they're all about. They want to just do this, right? The problem with clear aligners is regardless of what company you're working with, the lab fee associated with them is very, very high. So what ends up happening, but on the day sheet, if I do 4 crowns and a filling for $5,000 or a clear aligner case for $5,000 on the day sheet, that's $5,000 in production. And eventually that's going to be $5,000 in collections. The devil's in the details. let's say there's 4 crowns in a filling. Let's say I'm paying an average, and this would even be high, of $150 a unit for those crowns. So I'm paying $600 for those crowns, and I'm charging $1,200 for a crown each. So the fillings in the crown equal $5,000. So my margin, my lab fee on this case is 12.5%, right? So my margin per crown is like $1,050. That doesn't include labor and things like this. But, even with a PPO crown, if I was charging $800 and I was paying $150 a unit, my margin is still my lab fee is 18.75%, and I have a margin of $650. Do you see? It's not super high. Whereas if I take that clear aligner case for $5,000 and my lab fee is $1,800, it could be lower depending on the amount of participation of who I work with. My lab fee is 36%. My net is only $3,200 if I'm paying $1,800 for this case. But on the day sheet, they look exactly the same. It's $5,000 and $5,000. It's just, when I get billed or my credit card gets charged, that's when it becomes a problem. So where this becomes an issue is if a lot of your production is clear aligner based, then what you're going to find is it's happy on the front end. Yay! It's like eating, if you're on a diet, eating food that you shouldn't. You're happy going in, but afterwards you go, I really shouldn't eat that. You feel guilty. You don't want to go too crazy with this. Obviously, you want to offer them in your practice, but you don't want to make this the focus of your practice. Otherwise, you're going to end up with a situation where your overhead becomes unnaturally high and your profitability starts to get eaten away. The next point on how your practice is structured has to do with hygiene. Okay? So, again, since we're looking at whether you had an associate run practice where you had associate doctors in there that you were paying 30%, or let's say you were just paying yourself 30% as the owner doctor, okay? If you don't have enough hygiene, the doctor's pay as a percentage of overall collections is going to go too high. So I'm going to give you a little bit of math here. It's not that difficult to think with, but I want you to understand this. If you have a practice where 30% of your revenues are coming from hygiene, which is what at least 30% should be coming from hygiene, and 70% is coming from the doctor, then your associate pay, or your pay if you're paying yourself 30%, as a percentage of overall revenues should only be 21%. I'll say that again. If 30% of your revenues are coming from hygiene, and 70% is coming from the doctor, and you're paying at 30% for associates or yourself, the doctor compensation as a percentage of overall revenues should only be 21%. And let's just run through the math for a second so you can see what I'm talking about. So let's say you have an office that's producing collecting $150,000. The doctor does 70% of that. So that's $105,000, whether it's 1 or 2 doctors. Okay? The hygiene area or the hygiene department does 30% of that, which is $45,000. Okay. So the doctor pay at 30% of the $105,000 that the doctor did is $31,500, or 21% of $150,000, which was the total revenues for the practice. I'll say that last part again. Doctor produced 105, or doctors even. The pay for that at 30% would be $31,500, which is only 21% of the $150,000 that the practice did for the month. Where this goes wrong is if the doctors are producing like crazy. Let's say you're marketing like crazy to drive in a ton of new patients, which there's nothing wrong with that, but you're ignoring your hygiene departments. Let's take another example. Let's say we have an office doing $150,000. But the doctors are doing 125 of that, or 83% of collections, and the hygienists are doing 25,000, which is 17% of collections. It's a lot of new patient work, right? Well, the doctor pay for that 30% of 125,000 would be 37,500, which is 25% of that 150,000 in collections. So by suppressing your hygiene department and focusing more and more and more on doctor production, well, the compensation for that doctor goes up. And as a percentage of overall revenues, the doctor pay goes up. Do you see? And then there's less profitability at the end because you're not paying the hygienists the same amount that you're paying a doctor. If you have a hygienist doing, $2,000 a day and they're getting paid $50 an hour, they're making $400. That's, 25% or 20% rather of overall productivity for that day. So how this practice is structured, whether it's, you're going most of your production is coming from clear aligners, or how your hygiene department is functioning, because if your hygiene department and you're charging a proper fee and you don't have a ton of managed care, should technically be more profitable. You shouldn't be compensating, and the material costs should not be as high as it would be for dentistry, if that makes sense. So the hygiene should comprise 30% of your overall monthly revenues. It's just something to look at. So anyway, I apologize for all of these numbers. I'm not a huge fan of doing numbers in the podcast, but it was just something that hit me not that long ago, where I was looking at, the average doctor is just thinking, well, I'm at 45%, 50% profitability, but they're thinking with them as the doctor being chairside, because what they should be earning as the doctor is not part of overall practice profit. That's not what you should be thinking with. Okay. You should be thinking with, if you were to replace yourself, whatever's left over then is profit. And this is something to think with too. Let's say you're not paying yourself market rate, or you look at what you end up with at the end of the month isn't what you would be paying an associate. It's less. Let's say, you're doing $100 a month and you're getting paid $15,000 a month, but you're producing $70,000. Well, you should be making at least $20,000. But then you look, there isn't any extra money to give you. Okay, you track with this scenario? You can only pay yourself that $15,000 a month, and you're just barely making ends meet. Well, that tells you that you have a problem. Now, the reason you're not griping about it, because you wouldn't find an associate to work for that little, you're not griping about it because you're the owner. So who are you going to gripe to? You're just going to gripe to yourself, all right? But what you should be doing as an owner at that point is you should be looking and going, why is my office not profitable? What do I have to fix in order to make it that way? There's a reason why profitability is important. It has to do with overall business health and future potential. So again, sorry for all those numbers, folks. I do hope this helps. I hope it gets you thinking a little bit of a different way with relation to what ownership means, other than just being this, the quote unquote professional / owner. And don't forget, I have all those downloads for you on the episode webpage. We have the new overhead sheet and the new overhead guidelines. I have the information about our online platform, the communication and sales seminars, as well as the production calculator. That's about all I have for you this week. I really hope this helps. Folks, have a great week. We'll see you at the next episode.